All right, good morning, everybody. Thank you for tuning in to this week's Spider preview. We're going to take a look at all the different economic sectors that make up the S&P 500 and see if we can get some kind of insight to where the market's going to go. Now, I've been getting a lot of fan mail and emails, and I appreciate them where people are saying like, "Yo, you were right," this, that, and the other thing. But that's not really what I do here. I'm not trying to give advice or recommendations. I'm just trying to give a roadmap to what's going on in the market. And also, too, pride comes before the fall, so I don't want to get arrogant or anything like that. But I've been doing this for long enough that I know that, I mean, that's not going to happen to me because this is a very humbling business. You never know what's going to happen. But in general, things played out the way we thought, right? A month or two ago, some important uptrends broke, some supply or support levels broke. So it was easy to see the big sell-off coming, and we even talked about it. And all you got to do is page back a few presentations to my Spiders preview in September, and then we saw clearly that the bottom had come, and there was going to be a rally because things got oversold, and the S&P got to 2,600, and there was support there at the beginning of the year. So again, it's the mantra, right? Oversold at support could be a bounce, overbought at resistance could be a sell-off. So just remember, when the markets are moving, there's probably a 99% chance that it's not what the idiots on television are talking about. It's not because of a trade war or the Kavanaugh hearings or the Turkish lira. Basically, what happens is this, okay? There are certain levels that are more important than others in the market with regards to the amount of supply and demand that exists at them. We just mentioned the 2,600 level, and we'll take a look at that in a few minutes. Okay, it was important now because it was important 9 months ago or 10 months ago. So in financial markets, prices are always doing one of three things: they're going up, going down, or staying the same. So if you can identify and understand these levels and trends, it's going to help your strategy. All right. And I don't follow things like Gann theory and harmonic charts. And frankly, I think stuff like that is a disgrace to the discipline or what they call technical analysis. The technical analysis, or what we do here at BHT, is trying to understand the supply and demand dynamics that are going on in the markets. All right. We don't use harmonic crab charts or whatever the hell they are. We're just trying to figure out what's going on. It's very simple. I've been doing this for a long time, and I can tell you that in 25 years as a head trader at various different hedge funds, I never ever once heard a manager or a successful manager talk about harmonic charts or Gann theory or even Elliott wave. I mean, that's another crazy thing, Elliott wave. Actually, I'm doing a big trading lesson. It's probably going to take a few weeks before I finish it. That's going to be on my site, where I'm going to talk about a lot of the myths and truths in what they call technical analysis, or what I call market equilibrium analysis. But if you're a steady listener, there's going to be nothing that's a surprise there. But whatever, it's coming out, and I don't know. Hopefully, I get it done by the end of the month. All right, so this is just an overview. You can get this on my site. All right, so here's the S&P, and you can see what I mean. All right, so the S&P got to 260, and this is the SPYs, so it's 260. This follows the S&P 500, which the S&P 500 is at 2,600, which I think I probably said. But for all intents and purposes, if you're trading, it's the same thing. When this thing's at 260, the S&P is at 2,600. So anyway, how did I know? Well, why did I think there was going to be support at 2,600? Because look where support was back here. Okay. So we're oversold. We're at an area that was prior support. We expected a bounce, and we also broke the downtrend. All right. So now look at this 270 level. So right now I'm on the sidelines. I was short a few months ago when we saw that sell-off come in. I got long last week when we saw the bottom coming in. Now I'm on the sidelines. I don't know what to do. So I'm just going to stay on the sidelines. You don't always need to be in the market. And I don't know if it has to do with this election that's coming up tomorrow. Obviously, I'm sure everyone, even my international listeners, know that there's the midterm election. Supposedly, it's the biggest interest in a midterm election since 1914. Which, what was going on in 1914? Well, it was the debate over whether to go into World War I or not. So shows you how riled up people are about this. What's going on. I don't know. The market's booming. The economy's great. I think people should generally be happy. But anyway, I don't talk about politics usually, but who knows? I mean, there's no doubt that the market's rally has to do with the Trump tax cuts. If the Democrats win the House, will they take that away? I mean, I highly doubt it. No politician ever took money out of someone's pocket if they weren't rich, and these tax cuts have benefited the entire population. So I think it's just rhetoric. But who knows? Maybe, they say the market, once the uncertainty's out of the way, it might rally either way. I think the biggest problem facing headwinds in the market is interest rates more than it is elections, because interest rates have been artificially low. And think about artificially low interest rates. I think if there's one person who deserves the credit or blame for the financial meltdown 10 years ago, it's Alan Greenspan, because this guy got so into his celebrity status, he artificially held rates low. Before Alan Greenspan, all right, there was a bubble every generation, because it would take a generation to die off before the new generation came in and said, oh, this time is different. Alan Greenspan comes in, holds rates low, and guess what? There's an internet bubble in, 2002 did it blow up? Or 2000, sorry, 2000. Then you had the commodities bubble, you had the housing bubble. It's all because interest rates were artificially low. So I think if the Fed is raising rates, the market will take that as a bullish sign. Intuitively, or the common sense opinion, or the common opinion, is rising interest rates are bad for the market. But we could be in an environment where a rising interest rate could be good for the markets, because it's showing the markets that they're not going to get overheated. All right. Here's a shorter term view of the S&P. And we talked about these levels. So I'm looking for resistance up here around 280. I mean, this was resistance here. It was resistance there. With support here. On the prior chart, you saw it was important earlier in the year. 270, support here. There's a bottom right here. So I'm on the sidelines now, and as long as the S&P is within this range. And we're not oversold anymore. We're consolidating. So we'll just have to wait and see. I mean, like I said, 2 months ago, I thought the sell-off when we were up here, I mean, this was pretty clear, right? Trend line break. Let me erase all this. All right. So this was clear. And this is when I first put out on my site talking about how looks like the markets are going to solve. So we have this trend line break, right? Pretty simple. Then when we broke this 286 level, that's when the sell-off really began. And we know 286 is important because on the prior chart, like we just saw, 286 was an all-time high back in January. So we were not surprised when the market got here and found resistance, and the market got here and found support. That broke. That was the sign of the sell-off coming. When we got down here to 260, like I said before, it was where the bottoms were earlier in the year. It was oversold. That was a sign that there was a bottom. So it's not rocket science, it's just common sense. And people do try to use rocket science for this stuff, but a competent technician could outtrade any rocket science thing I've ever seen. I mean, I'm hearing now a lot of these quant funds are actually not doing so well because there's just so much competition that they just aren't making the returns they used to. And if you just look at these levels, you can see, I mean, it's whatever, not rocket science. So anyway, going forward, I'm looking for resistance here. I'm looking for support here. If we get above here, I'll probably get bullish. If we get below here, I'll get bearish. But for now, I'm neutral. All right, so I'm just going to go through these sectors now. again, here's tech, and like I say every week, I don't trade this thing because it's just too volatile, and too hard to find a level. But anyway, this 68.60 level is important back here. You can see it was the bottom here, and now we're back above it. So again, if you trade tech, I'm looking at, and then, obviously this goes hand in hand with what we were just looking at in the SP because this is the biggest sector. I think it's 30%. So I'm looking for resistance around 71. Going back to here, you can see it's important there. I'm looking for support here. I know we broke through it there, but like I said, this is volatile and this is hard to trade, and I don't trade it, but I do keep an eye on it. And a lot of people that follow me want to hear my opinion on it. So take it for what it is. All right, now this is interesting here. This is the financials, and this is one of the main reasons why last week we talked about how the market was most likely at a bottom, because the S&P or the financial spider got down to the 25 level, which yes is important psychologically, and you can see it was pretty much the top back here and the top here, right? So last summer or last spring in March and the last summer in July and August, it was the top. Okay. So when we got there, it was no surprise that it was support. Now, this is a shorter term chart, and you can see. I mean, look at that. It's like within like pennies of being at 25. And I laugh when people like fundamental analysts and academic analysts take shots at us technical analysts. I actually call myself a technician or a market equilibrium analyst. I don't like the term technical analyst because it's just stupid, ambiguous term. But look at that. No fundamental analyst could have said, well, when this thing gets down to 25, it's going to turn, right? So anyway, yay me, I'm patting myself on the back. So we got down here, we rallied, we're back up above this 2640 level. I think the close was like 2646 or something, like right there. So I'm watching this level because it was the lows here, 2640, back in June and July. Okay, it was the lows in October before, we had the sell-off. But now we're back above it, and it got oversold. It's back above it. So short term, I'm watching 2640 for support. I'm watching 27 for resistance. 27 is an important level because you can see it was the bottom back here earlier in the year. And as you know, if you listen to me, I always like to show this chart. Show this to your friends who don't believe in charts, or your fundamental and academic friends. So, this is the this is the XLS before the sell-off. Where do they find a top? Pretty much exactly at 30.50. Where do they find the top last January? Pretty much at 30.50 exactly. So how can this thing possibly have the same valuation at two such different points in time? I mean, the interest rates are different, the economy is different, oil prices are different. Well, I don't know. I'm not smart enough to understand the fundamental reasons, but there are no fundamental reasons behind it. This is perfect example of how there are certain levels in the market that are more important than others. All right, so again, this is healthcare, or again, another example of a level that we talked about. 85.50 was the top here back in February and March. It was support here through July. So that's where we assumed there was going to be a bottom. Sure enough, where do the XLVs find support? Drum roll, 85.50. So we've broken the downtrend. This is another thing where we're on hold. I'm looking for support going forward around 85.50. I'm looking for resistance going forward around 92. And you can see we broke this downtrend. So I'm going to be neutral until these levels play out. Consumer discretionary also broke its downtrend back above this 107 level. You can see 107 was important back here. It was support before the sell-off, and now we're back above it. So again, this is another reason why I'm neutral. I'm looking for support at 107. I'm looking for resistance at 110. Until we go one way or the other, I'm on the sidelines. You can see that momentum is neutral. Industrials, back above this, we broke the downtrend and we're back above this important 71 level. 71 is important. And again, here's another example of a level that's important. I don't understand why certain academics and fundamental people just don't believe in this stuff. I mean, you don't need to be a chart guru to see 71 is an important level. So the bottom here, the bottom here, bottom here, bottom here. So anyway, we're back above this. So going forward, I'm watching 71 for support. I don't really see any clear resistance until we get up to here. And again, just remember that all these levels I'm pointing out, if the market is going to have a big sell-off, and it's probably due for one, just keep an eye on these levels, right? Especially keep an eye on the S&P levels, right? Don't listen to what the idiots on television are talking about. As long as the S&P is above that, you can be, or above 270, you can be in a holding pattern. I mean, the S&P might get up to 280 one day, right, where I talked about resistance. And there could be a sell-off, and the people on the media can be like, oh, it's a sell-off, trade war, blah, 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 this, that, the other thing. But in reality, it's not an important move. Certain days in the market are important, certain days aren't, okay? Like all these days back here, let me do this erase thing again. These days aren't important. These days are important. Well, what's an important day? This day is important. Why? Because we got to an important support level and we rebounded. This day is important here. Why? Because we got to resistance and we rebounded. So most days are not important because no important technical things happen. But when trends are broken or levels are broken or levels are rebounded off of, those are important days. So basically, I mean, I'm not going to go to the beach because it's November here in Connecticut, but I'll probably do a lot of walking with my dog in the woods, and I'm not really going to make a move in the markets until one of those levels is broken. All right. I'm talking too much. So this action in staples was really interesting because as the market was going down, it was going up, or they were going up. And that has to do with the fact that people consider this a bearish sector, right? Because you're always going to need staples. Staples are like food and water, whereas discretionary is high-def televisions and so forth. So the thought is the market's going down, the economy's getting bad, let's invest in staples. So there was bullish action in the staples due to a bearish view in the market. So anyway, so it's still in an uptrend, it's just been consolidating. Watch this 53.50 level. You can see it was support here, it was resistance here, support here, resistance here. So we're back above it. So I'm going to watch that 53.50 level. Longer term, look how important this 50 level is, all right? It was basically the top all throughout 2015. It was the low last year in September. And I know this is hard to see, but it was basically the top all throughout May. So if you're looking for some longer term indications that we're going to go into like a big market meltdown, I mean, I know it's, this thing would have to drop 10% first, but anyway, just keep an eye on this 50 level. If this thing breaks, this thing could go way lower. Okay, energy, once again, we're in another kind of range-bound sector. You can see found support around 66.50. This was the lows back here. Again, not rocket science. We were oversold. We had a prior support level. And we rebounded. So I'm watching 66.50 on the downside for support. I'm watching 72 on the upside for resistance because 72 is where the bottom was in August. 72 is where the bottom was in September. And here's another interesting chart, which shows that levels are important. All right, 78 level, basically the exact top there, exact top here, exact top here. All right. So this is back in 2016. So this is 2 years ago. Okay. Early 2018. Anyway, you get my point. 78 is an important level. If we get back up there, I would imagine there's going to be significant resistance. On the downside, we just talked about the 6650 level. You can see how it was important here, here, here. So I'm watching the 6650 level for support. And materials, this 2 is back above a level. And I mean, here's the thing, right? It's like bottoms are tougher to figure out than tops because bottoms are more volatile. And I really put my main focus on the SPYs. These are kind of just peripheral things to look at. I mean, I know if you're trading them that they're not peripheral for you, but you know, I'm just trying to focus on the broader markets. And all right, so look at this: 5350, top here, bottom here, back above it. I'm watching 5350. I'm watching 58 for resistance. All right, last but not least, utilities broke their uptrend. Watching these things is like watching paint dry or grass grow. Although I was actually watching a show on bamboo last night, and bamboo is grass, and in certain parts of the world you can literally see it grow because it grows like 12 inches a day. But I guess after a while that'd be boring too. So anyway, these things go lower. I'm watching 52. They break 52. I'm watching 49. So, all right. Well, that's it, I guess. Thanks for tuning in. Again, we're on the sidelines here. I guess we'll have to see how this election plays out, how things go forward. So thanks for tuning in, everybody, and I will catch up with you next week. Have a good week until then. Thank you.